the latest GDP readings on an annualized basis for the fourth quarter numbers. We saw the GDP numbers basically show growth of around 2.4% quarter over quarter. The estimate was for around 2.3%. So the market will try to figure out, when looking at backward-looking data on the economy, whether or not the uncertainty on the economy ahead changes the storyline at all for the Federal Reserve. It does look like, at least initially, U.S. futures were coming off their recent lows. We also got some jobless claims data for the week of March 22nd, where claims came in at 224,000. The estimate was for right around 225,000. Greg Taylor of Purpose Investment with us at this hour. And Greg, the sensitivity of the economy because of all the tariff talk has taken center stage. We'll see how the market digests this with the fact that we're already dealing with a fresh round of tariff uncertainty today. Yeah,
the market seems to flip-flop between whether good news is bad or bad news is good. And right now, I think we're in the camp that good news is good for markets. And this is a positive surprise. It's not a huge beat, but it's going the right direction. And it might alleviate some of those fears of a growth slowdown that was starting to creep in the market in the last few weeks. So futures look like they're recovering off of this, and we'll see if that can hold through the open. Okay, well, against that backdrop and the interconnected Canadian and U.S. economies, we want to talk a little bit more about the road ahead for Canada. Bank of America Securities is holding its global macro conference for 2025. And joining us in studio today will be several key strategists and economists from the B of A team. Ohsung Kwon is with us now, U.S. and Canada equity strategist with B of A Securities. Great to have you here.
Thanks for having me.
In such an exciting time, regardless of whether or not we know how things are going to play out. What's been the most common question you've been getting from clients on what's happening these days?
Yeah, obviously it's been tariffs.
Yeah.
Everyone's really concerned about tariffs and what that's going to do to the economy and the market. But if we forget about tariffs just for a second, I know it's very difficult to do, but if you just do that for a second, I think the macro cycle itself is still pretty healthy for equities. We are seeing manufacturing cycle coming back for the first time in 2 years. It was the longest downturn in history. We saw corporate earnings posting 15% EPS growth in Q4. And I think the consumer is still pretty healthy. I mean, it might not be as strong as it was, but I think the overall consumer is still healthy. So, and the tariff uncertainty is probably at its peak right now. Hopefully after April 2nd, we're going to see some certainty. And I think that itself could potentially unlock some of the CapEx investments and consumer spending. So I think things are going to get better going forward.
It is the wild card, and we'll see what happens. But point taken, and even when we're talking about Canada's economy, which seems like it is right at the center of this storm right now, but coming into the year, one could argue that things were looking relatively good before the narrative very much shifted.
Yeah, exactly. And I want to say at least the first half of the sell-off that we saw in the U.S., I think that was more driven by positioning. It was more technical. That U.S. was really, the only game in town for the past 2 years. And now that we're seeing some better data from Europe, China, even Canada, we saw that big rotation, and U.S. became sort of the source of fund. And if you look at our Canada cycle indicator, it's at the 2-year high. So things are actually getting better in Canada compared to the U.S., at least for the equity market. So I think the cycle itself is still pretty healthy.
So just to build on that, you're right. The U.S. market's been the place to be for the last 10 years. And for the first time in a while, we're seeing the U.S. lag other markets. We're starting to hear some of that cash coming back in. Some of it's sector rotating. But do you think there's money going to flow out of Europe back to the U.S. because of the move we've had to start the year?
Yeah, I don't think you want to sell U.S. equities per se. U.S. is still the market that has all the technology stocks and all the best companies in the world. There are still a lot going for the U.S. economy. I mean, we are energy independent. It's a very business-friendly market as well. So, I think it was more of a rotation, technical force that really drove that sell-off so far this year. But I don't think you want to necessarily sell and rotate out of U.S. equities at this point.
One of the, I guess one of the other economic questions being asked is if we continue to talk about the cool down worry for the economy, but also the potential of inflation returning, the idea of stagflation, we're starting to hear a lot more of that kind of talk. What is the data telling you right now?
We're not seeing that much evidence of stagflation happening or recession happening. I mean, first of all, stagflation only happens less than 10% historically. And if you look throughout the history, stagflation has been accompanied by oil shocks, and oil prices are down. So I don't think the stagflation concern and recession concerns, those are justified. It's really been just the soft data softening, not necessarily the hard data. I see this more as a confidence shock rather than an actual fundamental demand shock to the economy. And I think that could potentially go away going forward.
Where do you stand on the Trump put? There's been a lot of measures about Trump does care about the stock market as much as he says he doesn't, and then more recently. So where do you think the Trump put is, where he'll start to turn and become more market friendly?
Yeah, we haven't really seen that yet. I think the strike price is probably a lot lower than what the market was anticipating. That being said, I think the headline risks are going to get better going forward. That, I think post April 2nd, we are probably going to hear less on the tariff front, hopefully, and we're going to hear more from the administration on the tax cut extension and things like that, the more market-friendly agenda. So I think that's going to get better going forward.
And then I did want to get your perspective on the profit picture, because Greg and I were talking about that earlier. We're now in the doorstep of earnings season. And there's so many moving parts, because you could make the argument that all the headline uncertainty has changed the profit picture for some companies, particularly later in this year. I can think of several examples, both in Canada and the U.S. recently, of companies basically lowering expectations. But then I also saw some data from Bloomberg suggesting that, at least for Canada, that the profit story compared to the S&P 500 has, for the first time in a while, been looking better, at least coming into these first quarter results. So how are you thinking about earnings? Because obviously earnings impacts the willingness to move into certain stocks, valuations, that kind of stuff.
Yeah, I think for Q1, actual results are going to be okay. I mean, we really started seeing only the soft data weakening in February. Hard data still seems fine. So I think companies are going to post solid results in Q1. That being said, companies are going to sound more conservative because of all the uncertainty. And that's essentially what we saw back in Q4. Even though companies posted 15% EPS growth in the US, and if you look at how companies sounded, so we have this natural language processing model to essentially to count the number of positive words versus negative words.
Oh, wow.
And it was at an
AI impact on Wall Street. Yeah.
Exactly. Yeah. And it was at an all-time high in Q4. Companies were sounding better than ever in Q4. Despite that, if you look at actual guidance that companies were issuing, it was actually really weak because of all the uncertainty. And yeah, there's some seasonal factor as well. Q4 earnings season, companies typically issue more conservative guidance. But in Q1, because of all the tariff risks, we can see guidance even becoming more conservative.
Yeah.
But I think the fundamental backdrop is still okay.
Still okay. All right. Well, great perspective as always, Ohsung. Thanks very much for joining us in studio this time. It's nice to see you.
Thank you.
Ohsung Kwon is U.S. and Canada equity strategist with Bank of America